Welcome to Macrobytes with Greg Dacko, EY Parthenon Chief Economist. In this episode, Greg is joined by Katie Johnson, EY Strategy and Transactions Partner, and Mitch Berlin, EY America's Vice Chair of Strategy and Transactions.
Mitch and Greg, thanks for being here today.
Thanks for having us.
It's great to be here.
EY recently surveyed a number of executives and board members, and for 2024, the economic environment and capital allocation are the key priorities. Greg, would love for you to talk a little bit about the economic environment and how that impacts capital allocation.
I think one of the interesting facts about 2024 is that for the first time in about 4 years, we're going to see interest rates fall because central banks are going to be cutting interest rates. And that's going to be very positive from a CapEx perspective, from a hiring perspective, as well as from a deal-making perspective.
And this is great news as well for the private equity firms because they're looking at their portfolio companies. A lot of the acquisitions of those companies were leveraged. And so that debt is coming to maturity and they need to evaluate, is the cost of capital going down? Should I refinance today and hopefully within a year or two get a lower rate and average out to something that's reasonable, that doesn't completely blow up my business case for acquiring that and my return on investment? Or should I lower the valuation now and try to exit through a divestiture or IPO?
Declining interest rates is something that I think many people have been very much looking forward to.
Everybody's been anticipating that, yes.
Greg, would love for you to just comment a bit on how that may impact capital allocation.
Yeah, I think when you look at the overall refinancing needs from corporations around the U.S., you're looking at about $800 billion of debt refinancing needs over the course of 2024. That's quite a large amount. What's important also to remember is that interest rates are now higher than they were before the pandemic. So you're looking at interest expenses that are about 2 percentage points higher than they were before. Now, that's big. It means that investment grade debt is about 2 percentage points higher, about 4.5% versus 2.5% before the pandemic. You're looking at high yield debt that is around 8% versus 6% in terms of refinancing needs. So that is going to lead to some stress in terms of capital allocation. But at the same time, when you think about a medium to long-term horizon, interest rates are not likely to go further up. They're likely to come further down. And that is an opportunity to refinance and think strategically about how to allocate capital that is being freed up by reduced interest expenses.
Mitch, where do you see companies investing capital?
So to the extent they have capital, we see them investing in M&A. M&A continues to be the fastest path to transformation.
Mitch, are we seeing anything specific by sector?
We are. So if you look at a consumer, particularly retail, for example, there are significant investments being made to create a more bespoke customer experience, because if you understand that there's a continuous movement from brick and mortar to e-commerce and online, it's important that you try to differentiate yourself, and companies are trying to do that by a more curated customer experience. So money being spent on that in retail. In life sciences, you're continuing to see the acquisition of R&D pipeline through M&A. A number of life sciences clients have patent cliffs, and so the fastest way to repopulate your R&D pipeline is through M&A. And then in the technology sector, there's significant spend, not only in buying some of the smaller technology companies, but also actually in manufacturing. Because of the CHIPS Act, there's already been $160 billion of committed spend to manufacturing of semiconductors in the United States. And so you're seeing companies invest in enhancements to their overall value chain, how they manufacture, how they ship, how they communicate with customers, because that creates efficiencies that they then ultimately gets them to an improved bottom line.
A deeper focus on productivity,
right,
I suspect. And I know, Mitch, you were just talking a little bit about some of the sector dynamics from a capital allocation perspective. Can you comment a little bit about what you're hearing from your clients and from executives that you're speaking with?
Yeah, sure. So we're helping clients on the front end and the back end. Clearly, postmortem reviews to make sure that they made the right investments so they can understand from past mistakes and past successes. We're working with them on that. Did they get the desired return on invested capital? Did they get into the market that they wanted? Did the product get the adoption that it needed? All of that we're working with them in a postmortem way. But more importantly, we're working with them going forward to help them make sure that they're making the right investments now, because again, they have such limited capital, they need to make sure that they're placing the right bet. So what's going to get them the biggest bang for their buck?
And we spoke about the ways to fund these capital investments and talking a little bit about refinancing. We spoke a little bit about non-core assets and looking at portfolio. Can you speak about a few more examples of the ways that we're looking to fund?
Yeah, in the past
capital?
few years, we saw a lot of use of private capital, but that's expensive. And so there's, as Greg had mentioned, there's a lot of excitement about the thought of the Fed borrowing rate coming down, and people can then, re-enter the traditional lending market and fund some of this growth and expansion. But while they're waiting for that, we are working with a lot of clients to do cost takeout, cost reduction exercises, working capital programs. As we mentioned earlier, looking at their portfolio and divesting non-core assets, non-core brands, non-core geographies to raise capital to divest.
Free up capital to be able to focus in other areas.
And that's an important point, because when you look at interest expenses from a corporate perspective, they generally have a negative effect. Whenever interest rates rise, it's not surprising, but that has a negative effect on CapEx, on hiring, on deal-making activity. The same works the other way. So as you were saying, when the Fed is going to start cutting rates, you're going to see interest rates across the spectrum start to fall. That is going to create new opportunity for new CapEx, new hiring, and new deal-making activity. So it's all about managing that discipline and that agility, knowing when to go into the market, when to act, and when to essentially take advantage of opportunities that you see.
Great. Well, I can appreciate, based on all of your perspectives here, why capital allocation is going to continue to be a focus and a priority for many executives in 2024, with a focus on discipline, to your point,
Yep.
as well as agility. Mitch, Greg, thank you so much for your time this morning. I really loved spending time with you and your insights around capital allocation.
Thank you.
Thanks for having us.
Tune in next time for another episode of Macro Bites.